This $216 million lawsuit isn't just about money. It's about a pattern of executive behavior during financial crises that directly impacts your ability to recover lost investments and understand corporate liability. You've seen companies collapse, but have you ever wondered what happens to the critical data that could determine who gets paid? This case reveals a chilling strategy employed by executives. We're going to examine the hidden economics behind executives moving their files, how it affects liability, and why this pattern, exemplified by the CrowdStrike situation, devastates stakeholder recovery. To understand this, let me show you the sheer scale of financial distress that triggers such desperate measures, setting the stage for the complex dance of liability and recovery. When a company faces a catastrophic event, the stakes become astronomical, transforming everyday business operations into a high-wire act where every decision carries immense weight. The financial landscape is littered with the wreckage of companies that failed to manage risk, but the true cost is often hidden in plain sight, impacting millions of consumers and investors. This isn't about a simple accounting error, it's about deliberate actions taken when the ship is sinking. Actions that prioritize certain parties over others, often leaving you with nothing. Now let me show you the specific pattern that emerges, a playbook used repeatedly when financial structures begin to buckle under immense pressure, impacting everyone involved. The first stage often involves a subtle shift in executive focus, moving from long-term strategy to immediate damage control, prioritizing personal and corporate assets above all else. This is where the concept of liability economics truly comes into play, dictating who bears the brunt of the financial fallout when things inevitably go wrong. Consider the historical precedents. Empires have fallen and markets have crashed, yet the underlying human and corporate responses often remain remarkably consistent. Understanding these historical patterns provides crucial context for today's massive lawsuits, revealing that current executive actions are not entirely unprecedented. The CrowdStrike case, with its substantial $216 million lawsuit, serves as a stark modern example of these deeply ingrained economic and behavioral patterns in action. Here's where it gets particularly interesting. The focus shifts from saving the company to insulating key individuals and entities from the impending financial storm. The crucial evidence lies in the digital trails, or rather the deliberate attempts to obscure them, as executives meticulously organize or even move critical files. This isn't speculation. I've linked the verifiable legal filings and financial reports in the description below, detailing the accusations and evidence presented. Think about the implications. If the very documents that prove liability or dictate recovery are systematically moved or altered, your chances of regaining any lost capital diminish drastically. This specific litigation highlights how crucial data management becomes during a crisis, turning simple file organization into a potential instrument of financial obfuscation. The pattern is clear. As financial distress mounts, the emphasis shifts from transparency to strategic compartmentalization of information, impacting regulatory oversight. Regulatory bodies are meant to ensure fair play, but their effectiveness is severely hampered when the core data required for investigation becomes inaccessible or tampered with. This creates a significant challenge for shopper recovery, as the very mechanisms designed to protect you are undermined by executive actions that prioritize self-preservation. Why does this happen? Because the economic incentives often align with such behavior, especially when executive compensation is tied to specific outcomes or personal assets. The liability economics at play are designed to protect those at the top, often at the expense of the broader stakeholder community, including everyday shoppers and investors. Imagine a scenario where the infrastructure investment you relied on is suddenly in jeopardy due to hidden financial maneuverings. Your recovery prospects become bleak. The insurance industry, designed to mitigate risk, also faces immense challenges when the underlying causes of a claim are deliberately obscured by corporate actions. This leads to a cascading effect, where the initial financial crisis is compounded by a crisis of accountability, leaving victims struggling for justice. You might be wondering how such a situation is allowed to persist. The answer lies in complex corporate structures and loopholes that have been exploited for years. The $216 million figure represents not just a financial loss, but the culmination of years of regulatory oversight gaps and executive maneuvering during economic downturns. This case is a powerful reminder that understanding corporate bankruptcy isn't just about numbers. It's about human decisions and their often devastating economic consequences. So, what should you take from this? First, recognize that the pattern of executives moving files during crises is a real and present danger to your financial security. Second, understand that liability economics often favors those in power, making proactive awareness and informed investment crucial for your own protection. Third, demand greater transparency and robust regulatory oversight to ensure that when financial crises strike, accountability, not obfuscation, prevails. This isn't just about a single lawsuit, it's about a systemic issue that impacts the fairness of our financial markets and the recovery potential for countless individuals. The core principle is this: knowledge is your greatest asset when navigating the complexities of financial downturns and corporate malfeasance. If this examination of hidden economic patterns has opened your eyes to the risks, subscribe, because our next video will dissect the regulatory cost analysis of another major financial collapse. Will you be prepared when the next crisis hits? Understanding these patterns is your first line of defense. The executives moved their files and the shoppers lost their recovery. But you don't have to lose your understanding. Remember this: the same patterns that led to past collapses are always present, waiting for the right economic conditions to resurface. This is the core of financial analysis for catastrophic events, recognizing the predictable human behavior within unpredictable market chaos. The intricate web of corporate structures and legal loopholes means that vigilance and informed awareness are your most powerful tools. By understanding these mechanisms, you can better protect your investments and advocate for a fairer financial system. The legal battles are complex, but the underlying motivations, self-preservation, and asset protection are remarkably simple. This deep dive into the $216 million lawsuit shows that the economics of a crisis are often shaped by deliberate actions. Ultimately, the goal is to empower you with the knowledge to navigate these treacherous financial waters more effectively. The pattern of executives prioritizing personal assets over stakeholder recovery is a recurring theme in financial history. Understanding these economic behaviors is crucial for anyone looking to safeguard their financial future. The consequences of obscured liability extend far beyond the courtroom, impacting entire economies. It's about ensuring that when disaster strikes, accountability is swift and recovery is possible. Thank you for joining us as we uncover the hidden economics behind financial catastrophes.